Hello everyone, welcome back to the RationalInvestor.com's Daily Brief Recap. The fastest 10 minutes that doesn't seem like it ever is 10 minutes on the internet. But anyway, we'll try and make it 10 minutes today, but that means Brian's probably going to do like 20 minutes. Recap. But, looks like we're recording on 10 YouTube. Minutes, that doesn't seem like it ever is 10 minutes. We'll put that on mute, but good to see that we are live on YouTube. So here we go. All right, first and foremost, we are at the end of the summer. You hear this message constantly from Brian of late that the end of the summer, low trading volumes, low liquidity, lots of moves all over the place, and I got a funny feeling they did it again. We spent a lot of time today looking particularly at SPY put options. I was sort of joking over the past few days about FU moves in the market. Let's see, I don't know whether I have that chart in particular up just handy. Darn. Anyway, we spent a lot of time through the daily brief just talking about stop washes back and forth. So I think they did it again. Anybody that was aggressively shorting the top of the market, they just did a nice little polite FU. And then promptly on the other side of the FU, we had a whole bunch of econs come out. Some of them pretty nasty. We actually spent some time in the daily brief looking at them. I suppose if the econs came out relatively friendly, everything probably would have kept moving higher. But we had things like University of Michigan consumer sentiment numbers come out, and everybody should look at this and go, holy crap, there's a big M. And are M's market friendly or unfriendly? Of course, the answer there is generally unfriendly. And then if we zoom out, we see that, gee whiz, there's M's within M's within M's, and the sort of general rule with regard to the University of Michigan consumer sentiment survey is a reading below 90 is sort of that consumer is happy and spending lots of money versus unhappy and getting worried. And so as you can see, print came in here 89.8. Could this waffle around this area and, humming and haw, do we, roll over, does the consumer, turtle kind of idea? Yeah, it may, play around here a bit. We might even get revisions here in September. That often happens. But the point of the matter here is I think we need to be respecting sort of the bigger picture message that's going on here. And of course, as soon as I mention this, I almost guarantee there's going to be a downvote for this video. But as I've said repeatedly over the past year or two, and you can actually see how this has taken about a year to roll over. But trade wars never end well. Political uncertainty, not good. Uncertainty for businesses going forward. Do we start expansion projects or do we put everything on hold? I think, we're getting a lot of that sort of on hold kind of message right now. And as well, we had sort of Chicago PMI numbers coming out as well. Sort of waffling right at that sort of magic 50 level for PMIs. You see last report was well below 50. That sort of, oh boy, are we going to roll over here? So, the writing's on the wall, everybody. We had just very brief yield curve inversions the other day. I think the yield curve's actually cleaned itself up a little bit here just over the past couple days. That's sort of that risk on, risk off kind of conversation. As we're sort of heading into this end of the summer, I don't know whether we take a bunch of this with a grain of salt, but you can see bond prices have come back off a little bit, yields back up, so we're not in sort of catastrophe mode anymore. But really what I wanted to talk to you guys about here today was really interesting anecdote about, through the daily brief we had a few interesting conversations. US dollar index, really ironically enough, this is actually the ultimate market fear proxy, i.e. I don't want to be in any growth assets, I don't want to be in any risk assets, I'm just going to go buy the US dollar, buy US treasuries, buy T-bills. They're giving a fantastic yield relative to the rest of the world, and I'm just going to sit there and turtle. Seeing the US dollar index, and yesterday we talked about 1.618s through the daily brief. We looked at different harmonic patterns, 127.2s, 0.618 golden ratios. Seems almost like a slam dunk here now that this harmonic is firing, and you can see we're actually even taking out this recent high here. But what's driving this? And I mean, it makes sense. Europe makes up a huge component of this U.S. dollar index. Europe, the euro right now is getting its butt kicked. Of course, lots of political uncertainty around Europe, and then also too, and we've talked lots about the bearish bots setups that are working on things like euro and British pounds, right? I don't think anybody in their best interest is a good idea for you to go and load up on European assets right now through all that uncertainty. And then, and this was an interesting conversation we had today, a little bit of a sort of a tutorial for the site. Japan doesn't have a drop of oil on the whole island, unfortunately. I mean, maybe they do, but, sort of anecdotally, they don't. And so as a result, and everybody remembers world history, how sensitive the Japanese were around the 1930s and 1940s to the U.S. embargo of oil, and how that, ultimately a lot of people conjecture that was the reason why the Japanese went to war with the Americans. Japan is incredibly sensitive to oil prices. So, whether it's risk on, risk off, we've talked about oil itself being sort of risk on play, and if it was moving higher, Japanese yen risk off trade, no confidence in growth, so we're going to go run into anything that's sort of stable. Japanese central bank, I think, is now the world's sort of alternative to the U.S. Federal Reserve if it's perceived that the U.S. economy is shrinking. So Japanese yen here, notice crude caught a bid, Japanese yen came off here. I'm getting the impression that a lot of the oil price bid up was hurricane related. You had those huge drawdowns in inventories, and thinking back in hindsight, maybe that was sort of a play there. As well, too, I heard that OPEC was really trying to, and Russia sort of working in conjunction with OPEC, was really trying to curb production. But I'm hearing a lot of people talking about how OPEC is cheating and how Russia cheated. So to a certain degree, I think the headline today was Russia produced more than sort of what they agreed they were going to. Big surprise. I mean, that happens all the time with OPEC and oil. So, not a big surprise there. I was just being facetious. Interesting conversation. Long and short of it here, we've got basically, yen relatively weak, European currencies relatively weak, and so what a surprise. U.S. index rocketing higher, and it's a pretty tough market for sort of how do I say this? Growth prospects out of Europe. And even really, I don't think that the oil market has really gotten going in earnest here yet. I guess what I'm also interested too, remember we had sort of said yesterday we have sort of bearish bots and stuff working off of this potential breakdown here in the yen. And so today I pulled up, in the daily brief, I pulled up the gold chart, and really more importantly, what I wanted to talk to you guys today is about the gold stocks. But you can everybody looking at this chart should clearly see this candle M potential top here in gold. That would sort of correspond with the yen coming off here a bit, and also to maybe the bonds rolling over. All those risk off proxies maybe taking a bit of a break. But the market that I really wanted to point out here, which is what I think, there's an old adage in the market that the gold stocks are the ultimate leading indicator for the gold market. Who better to know what the prospects for gold price would be than the companies that are actually involved in the space, right? That makes sense. And lo and behold, we have a really interesting chart pattern here trying to develop. In that this is what we call an empire formation. And think of sort of empire states building. So we actually have a very cool little sort of cut and dry message from the market. And gee whiz, this is setting up. Keep in mind this market will be closing in about 2 or 3 hours for the weekend. On Tuesday, the pros will come back from vacations, Hamptons, all that. And I think we're going to get a really quick, simple tell as to whether the pros think this is a risk on or risk off environment. And my suggestion to everybody is watch this empire pattern on the gold and silver stocks really closely. If this fires, you can see we have an inside bar here today. If this fires, then I think that the metal space has got to take a bit of a pause here. If we can hold these lows, remember we had this conversation about US dollar index about a week or two ago. That empire never did fire, and the US dollar just kept marching its way higher. Ironically enough, actually strong US dollar index, gold really shouldn't move up in the face of that. So, maybe we're getting a little bit of anecdotals out of the US dollar index forging the news highs here, but my hunch is, and this is what I'm going to be following coming out of the Labor Day weekend, is how do the pros interpret this potential empire top here on the gold stocks. We had a really cool conversation in the daily brief today for all the day traders. A couple really cool sort of learning pieces here. I won't go into too much detail because, simply we don't have enough time to really explain this, but we have this is our little icon on the site for one of the guys that I would respect. He was a 30-year floor veteran on CME, John Hoagland, and there is Hoagie right there. And props to him. I absolutely love John. In fact, I often even retweet Top Steps daily sort of video where John actually sort of sets up what the trading day is going to look like for him. So, maybe check that out if you can. John's just such a fantastic person. He's just an absolute sweetheart. But this is his sort of Hoag's 80% play, where in essence, if the market, and you can see we were ratcheting higher here, then we came dumping down. If you look at the previous day's session and we accept back into value, 80% of the time we have to go down and tag the other end of value. Now, in this case, it was very quick, it was dirty, it was cheap, but nonetheless, it worked. Where the market came down, accepted back into value, and then went quickly ratcheting down to value low. So Mr. Hoagland's 80% rule, this is another one of the statistics to validate that 80%. But we also had a really cool scenario here too. Keep in mind this is a holiday weekend, day traders. When you're looking at these kind of markets from this perspective, it's totally a day trader's kind of perspective. So, think about position squaring and all that kind of conversation. It didn't surprise me that as we were coming into this vertical line here is the European close. The Europeans were basically, they had to close long positions, especially day traders, margin requirements, all that. They have no choice. They have to have these positions closed by the end of the business day. So what a surprise, the market just dumps right into that event, and then right on the European close, boop, she pops back up. And the irony of it all is that you can actually see that on the sort of other side, keep in mind Asians, Europeans, they're all gone for the weekend, and now long weekend too. You could even argue that there's a potential for a nice AB equals CD push up into sort of this 293 and change area here on the ES. And also notice too, there's a nice little hole in the profile that could be filled in here nicely. I like to watch the SPYs really closely, the spiders, simply because we get lots of options, weekly options, open interest kind of data here. And when we looked at the options open interest, we noticed that there's a pretty big open interest up here at about 295. So maybe on the open there, the pros were able to square up their positions. Tough to say. But believe it or not, my hunch is that they would actually prefer to close this market up near the upper end of the range, just so they don't have to pay out on those put options. We'll see what happens because there's a fairly large call open interest up top too. So, it might be a mixed bag kind of message, but it really doesn't surprise me that the options boys are trying to get the market up as high as possible. And keep in mind that options expiry for the week, those weekly options, and this is the way it used to be. I'm not sure if it's still this way. I've been out of that loop for a while. But they used to settle up at 2 o'clock Eastern, 11 o'clock Pacific time. So let's see what the market does into sort of this 11:30 window. But I wouldn't be surprised if you actually saw the market work its way up into that event horizon. Really interesting little tutorial we did about things like Hoag's value trade for the day traders, and motivations of Europeans heading into their close, guys who were caught long getting screwed. Also too, really good conversation about value levels, accepting back into value, technically, if we, we dump through the low of value, if we can accept back into value, which I think is what this battle was here, really you could make the argument that, Hoag's 80% play can work the other direction, where we probably ought to go back up and tag value high. So, keep your your eyes peeled into the New York close here to see whether they need to work this market back up top here to try and ensure that those put options that they wrote expire worthless. Because keep in mind, that's just money in Wall Street's pocket if they can do that. Last thing I wanted to talk to you guys about today, of course, we don't have a daily brief recap without a good little talk about the corn and crypto. We did lots of analysis. In fact, I did really cool. I've been working on volume momentum studies a lot on the site recently. I built this MACD volume momentum study. Really cool study. Let's see if I can show you it here. I don't know whether I still have it open. Never did get to talk about Bollinger and all that stuff today, Kevin? I forgot about that. Where the hell's that damn higher time frame chart? I guess I got rid of it. Oh, here it is. So doing some really cool analysis, and frankly speaking, I don't think Bitcoin has actually broken down or broken out to the upside yet. We have all these cute little tails, and I think I even mentioned in these free videos that I didn't know whether we had actually failed here yet per se. We're, and keep in mind, like, this is the real pro trader sort of level. We're going to come in and buy against these lows and just simply risk to a break of these lows. Notice, if we just put on our Ray Burchett 38.2, whoops, that's not what I wanted. Let's try that again. Oh, isn't that weird? Oh, darn. Okay, well, let's see if I can just go quickly do this. Boom. And that's down there, so it's reversed. All right, so there is Ray Burchett sitting at 38.2, and you can see the very noticeable battle here. And what I noticed out of volume is that we're not really getting the push, that raw oomph that I want to see that says, yep, we are now officially trending in one direction or another. And they always say volume leads price. So it's kind of an interesting talk about Bitcoin here. And we also took a look at Ethereum. It's at a really important higher time frame level. It's trying to paint inside bars. This is an inside bar here today. Did see some chatter on Twitter about people saying, hey, I'm going long here, man. I think this is an awesome trade location. Buying against lows, selling against highs. It's a pretty solid setup. So I really don't have a problem with that. And frankly speaking, I think I had talked to you guys about this yesterday. There is my bot short level. According to my bot trading model, I've had my move stop to break even, scratch level hit. So my stop's sitting back at the original fail level. And as you can see here, we talked about this in the daily brief today. We have accepted back above this trend line. We could very easily now ride this trend line from the other side. Seen that happen lots. But I might actually make the argument that we're at, you can see the W here. We're heading into the weekend, position squaring. Now it's the crypto kids' turn. The pros are almost gone, probably in the next 2 or 3 hours. Most of the pros in Wall Street, they'll be gone. This event was all CME futures related. We could very easily see through the holiday weekend that price actually work its way back up. Keep in mind, I do have this short working, so it's sitting on the books, but I wouldn't be surprised if we got a tag of the POC, which of course is just below my stop level, and a tag of this trend line from the other side, which of course is just below my stop level. And also too, you can see the original market structure failure there, which again is also just a little bit below my stop level. So I'm more than comfortable just to sit in here. It's exactly what I said yesterday, and I want to be the demonstrator for best practices on the site, so I'm not really going to do anything. If I get stopped out at scratch, big fucking deal. It's no big deal. But at the same time too, I like this bearish setup, but I could very easily see some backfilling here through the weekend. So, keep that in mind going forward. Not really a buy signal for me. Kind of more like counter trend rally bounce. Now, if you're playing like lower time frames, 15-minute chart, that kind of thing, I think it makes sense. You could be hunting longs. And I think there was one other key level that I wanted to point out. Yeah, so off of this actual range where we broke down, and remember, here's our volume study. Nobody's really pushing either direction. If I get a big breakout either way that sort of resolves this sort of malaise wedge, then that'll tell me which direction we're going. Then I'll just look at my OBV direction tool to tell me which direction we're going. But I think, I just pointed out off of that other chart that, oh geez, now I lost it. Yeah. So this high here, I think, is sort of our uncle point, because you notice that is that breakdown low there. If we can accept above this level, then I think we got our shot right back up top. And I think that's completely realistic. And when I mean right back up top, I mean back up against this trend line here. And the POC and all that kind of conversation. And then when you actually do a fib off of this range, lo and behold, there's Mr. Burchett again, sitting 38.2. Those are those highs. This is that CME dump event. And also, too, if we can accept back above that 38.2, look at the profile. So you can clearly see that, I think the war is going to be here, and this is on stamp at about, well, let's call it 9,700. If we can accept back above 9,700, then I think we got a pretty good shot at rallying back up to 10 Gs. So I'll leave that with you for the weekend. Have yourselves a great holiday. We'll try and do a Broiler Chickens show on Sunday for you all in the public. But if I don't talk to you until after Labor Day, have yourselves a great day. All the best, and bye for now. In 21 minutes. Way to go, Brian.